Hello friends, here we are going to see the basic accounting terms which is being known as debit and credit. So what is this debit and credit in the accounting terms, and what are its what for what purpose it is being used, and what are its uses, right, in the financial accounting or any type of accounting terms. This is the basic fundamentals of to understand what is debit and credit in the accounting, right. This is the starting of the accounting from the debit and credit, knowing what it is and for what purpose it is being used. Debit and credit is basically a accounting terminology, you can say. Firstly, in order to understand debit and credit in accounting terms, firstly we have to understand few basic fundamental principles of accounting, which says one of that is going concern concept. Going concern concept, what does this say? This basically says that if we do accounting of any particular business, then we have to assume that that business is forever. It is not going to shut down within a month or within 1 year or 2 year, right. We have to assume that it is going concern, right. Going concern, it is going concern, it is not being it is not that it will be shut down within a period, limited period of time, except in some very few cases. For example, I can say in 99% concept we have to assume that this going the business will be continued forever, right. There will be no liquidation within the any period in 99% of cases. The exception is 1% cases you can consider, right. Another is double entry concept. Double entry concept, what does this say? This basically says that every accounting entries has two effect, right. When we get anything, then we have to pay for the same to others, right. Right, this is when we get anything we have to pay. This is one, for example, 1 rupees, 1 rupees worth some goods I have bought, then we have to pay 1 rupees, right. Then this becomes 1:1 ratio. This is basic concept of double entry. We have to record what we have got and what we have paid in order to get that particular items. Thirdly thirdly business entity concept. Business entity concept, what does this say? This basically says that there is the differentiate, we have to differentiate between proprietor, who is the owner of the business, proprietor, who is oblique owner, and with business. So why does we do this? In order to avoid any mistakes in the accounting terms, or you can say while showing the capital in the accounting books, we show this business entity concept in order to avoid any capital mismatch, right. You can say the capital mismatch, because when the proprietors put its capital in the business, we have to record that also in the business accounting terms. And when the proprietor withdraws some money, or in the accounting terms, the proprietor withdraws any amount from the business, it is called drawings, right. This if the proprietor withdraws any amount from the business, we shall have to record the same as well. When the proprietor puts in the amount in the business, we have to record, and when he withdraws some money from the business, that also we have to record. This is basically a business entity concept. In this we have to differentiate between business and the proprietor. We have to record each and every transaction in the business, irrespective of whether he is proprietor or any employee or anyone else, right. So now coming to our this debit and credit parts. Debit and credit basically means that and credit means that, in simple terms you can understand, debit means what we gain, right? Here we have understood what we get, right? What get, and here it is mean what we have paid. What we have paid, right? This debit and credit basically means that what we have received and what we have paid for the particular items, but it will be reversed in some cases. For example, when we create a nominal accounts, it will be reversed. We have to reverse this there is a income or gain, we have to reverse the three accounts which I am going to show here. You have to firstly understand this, and after that I will explain you uh, about the further debit and credit note credit debit and credit terms, right? Firstly you have to understand these three terms under which we align all of the accounting transactions. So we have basically understand that what is going concern concept. In order to understand debit and credit, we have to firstly understand all this. These all are aligned so that so as to understand what is debit and credit and fundamentals of accounting. We have to firstly understand these all the presumptions which we take in order to record the accounting transactions, right? So here we are going to see further three accounts which is very helpful, or you can say it is very important to understand in order to do business transaction and record the entries in the accounting books, right? Firstly is real account. What does this say? This says that what comes in is it will be debited, right? It will be debited, and what goes out, it will be credited. What does this mean? I will explain you later on, right? So number 2 is personal account. This is real account, next is personal account. What does this say? The person or the anyone who receives anything, it will be debited. Receiver will be debited, and the giver will be credited. Here we have understood real account and personal account. What does this say? Real account says that what comes in, what you receive in the business will be debited, and what goes out will be credited. We will discuss this in very good terms, the little bit after this understanding third term is very important. This will be reversed in this case. What example I have given right there, that will be reversed here. Third is nominal account. What does this say? If any income or gain is being occurred in your business, then it will be credited, not debited. Again I repeat, if any business income or gain has been incurred in your business, then it will be credited. And when any expense or loss has been incurred in your business, loss has been incurred in your business, then it will be debited. What does this happens and how happens? I will explain you right there, right after this. You can see that. So here we are getting with the next page in this example. So here we have understood that the real account details about what comes in will be debited and what goes out will be, as we have understand there. Now I am giving you a simple example about these all terms in the in this page, right? So when the real account, some of the examples of real account are, for example, cash account. Cash account of business will be comes under the real account, and the personal account, it is also only one example I am giving you. There is hundreds of examples I can give you later on in this video, or I will make a further video, but I will today let you understand all everything about the debit and credit part of this video, right? So real account, one of the basic example is cash account. Cash account comes under the real account. When the cash comes in your business, you will have to debit that particular transaction, and when the cash will be goes out from the business, you will have to debit that particular transactions, right? Now comes personal account. Personal, as the name suggests, it is related to some persons or some parties which are related to the business, right? This for example, you can say personal account is related to some parties from whom you purchase a goods. That is also personal account. Obviously you can understand. For example, if you purchase some goods from Raj and company, then it becomes a personal account for the business, because you are regularly doing transaction with the Raj and company, right? So this become a personal account. So if we have purchased some goods with cash from Raj and company, then what will be the transactions, how it will be recorded? This is one example I have given. I will give you examples in further videos, right? This is basic example I have given. One of the examples so as to understand the basic concept of accounting debit and credit, right? So we have to record this transaction that we have purchased some goods from Raj and company by paying cash to him. Then what does this say? When we what goes out will be credited. That means cash goes out, obviously it will be credited, right? So firstly we can record cash. Here we have to understand the basics process of accounting. While we are recording any transactions, while debiting we have to write by. While debiting anything we have to write by, and while crediting anything we have to write to. Once again I repeat, in the accounting terms, when we are debiting anything we have to write by. For example, we are debiting Raj and company, then we have to write Raj and company. And when we are crediting anything we have to write to, for example in this case, cash account. Firstly, once again I repeat, to better understand you, right? Real account has these basic fundamental presumptions that what comes in will be debited, what goes out will be credited, right? And one of the examples given in the real account is cash account. There is various examples, out of which one I have listed here, right? And what does the personal account says? Personal account says that receiver will be debited. The person who receives will be debited and the giver will be credited, right? So here, as per our business transaction, we have to understand that we are the receiver in this case, in personal account case. I hope you are understanding, because we as per our terminology we are receiving that particular goods from any party. Then Raj and company we are purchasing some goods, right? So here we have to record transactions as. Here Raj and company will be treated as personal account, right? And at the same time, when it under this one more account comes, which is called purchase account. Purchase account also comes under the personal account. What does this mean? Receiver will be debited. In the purchase account we are the purchaser, right? Then the purchase account will be debited here by purchase account. For example, for 100 rupees of goods we have purchased, and what in lieu of that we have paid, what goes out? Cash goes out. Cash is real account. Then we have to write cash account. Here we have to write. At the same time, what to do when we have written that particular goods? Have you understand? Once again I repeat, when we purchase the goods, we have recorded in this way, because the purchase account is personal account. When we receive the goods from any party or anyone, by paying anything, or by in credit also we purchase, then we have to record at the same time. There will be minor difference in credit terms, right? So while we purchase account will be debited, but what when we return the purchase, we have to record as buy cash account. Why? Because we have paid the cash in order to purchase that particular items, right? And when we return that particular good, in the return of purchase return, we will get that amount of money. For example, 100 rupees, out of 100 rupees, for 50 rupees goods I have returned, then the 50 rupees will be returned by that other party, right? Here we will make one more entry, that is to purchase return account. And it will be credited by 50 rupees. This is the basic fundamental presumption about the real account and personal account. Nominal account needs more detailed analysis, because it requires, because it is completely little bit different from the real and personal account. So as to understand this, we will discuss this in further video, or part 2 you can say, in order to fundamentally understand what this nominal account terms, right?